First of all, I want to get your thoughts on your risk appetite right now. We've seen a huge rally in the equity space, and many people have said this is something that we should have seen a while ago. Now we're beginning to see investors chasing the value we've seen in the likes of the banks, some of the consumer names. Has your risk appetite changed?
I wouldn't say just change because of like a quarter movement in things. Definitely year to date, I think the market has done about 31.6% or thereabout. Most of it was actually brought about in Q3.
That's right.
And most of that towards in September alone. Having to, for a fund manager to change the whole asset allocation and risk appetite over just such a short flip, and especially when other asset classes, the bond market has done almost twice what it recorded over half year, from 5.2 to about 10.4 to date. So it's, I wouldn't say so much about changing risk appetite all of a sudden based on these recent changes.
But how do you invest in this environment? How do you invest in a bull market? We've seen a bull market in fixed income, bull market in equities. How do you invest in this environment?
Well, I think for a fund manager, essentially the first thing is your asset allocation prior to the period. You have your own risk appetite and your different parameters. Now, definitely, even if a market is moving up, it has an upward trajectory, there will be some, the bopping up and down around that. Now, having this bopping up and down within Q3, I don't think it should just essentially be the game changer to your asset allocation right from one. In a bull market, it's quite good. Equities, just like we said, a lot of analyst views towards equity for the end of the year was about ranging from between 10 to 12%. Now, you've already doubled that. Now, definitely, now the other questions, it should be more of questions other than just jumping into the market to avoid what happened in 2007, 2008. What is going on? Where is the liquidity coming from? What are the companies doing that doing different now? No more new IPOs. So what is really driving the market? So it's more of questions. If they are like new corporate actions, one company buying the other, what is the new company buying the other going to do differently that is going to drive the revenue? So for me as a fund manager, or for us as a fund manager, it is more of questions. What is going to happen? We have a long-term view for the funds we manage. We manage 4 funds, of which we have decent weighting in equities as well. So if you're meant to manage funds over the long term, it is more fundamentally strong stocks you want to keep. So even if there's a bump up at the moment, is it sustainable in the long term for you to deliver returns?
I think what I hear you say is that the fundamentals haven't really changed. It's more been a liquidity-driven market. That's what a lot of people have been saying about equities recently. And because of that, we've seen the likes of the multinationals, the Nestle, Unilever, etc., become extremely richly priced. I mean, that's what many people think. And the consensus is that they are already massively overpriced now. Your thoughts on how to get value from this market if you're not going for those blue chip names?
The truth of the matter is one major thing outside from the fundamental statistics of all these companies is the liquidity behind them. Now, if the liquidity is not so strong, just a little, our market trades about 2.5 to 3 billion naira every day. I mean, that's about 0.05 of a foreign hedge fund manager's appetite, or even for an emerging market. But in addition to if our own pension fund administrators are coming on board, other fund managers like myself are coming on board really strongly into the equities market, of course that will force, liquidity squeeze will just force the prices to go up, and that will now create an imaginary bubble. So one has to be very careful, especially when you're doing fund management over the long term. It's not like a momentum fund or an aggressive growth fund. You have to be careful to actually select, know what you pick for fundamentally. So in playing, just back to your question about in playing in those other stocks which are not the blue chip names, I wouldn't know, in terms of blue chip, it now depends, because fundamentally some companies could be blue chip, but if they don't have the liquidity to trade in them, that could be a problem as well.
So that's still a risk. And of course, one of the things that the stock exchange is trying to do to address that is the introduction of the market making program. But coming back to the point on where else to go in this bull market, clearly the large multinationals seem to be richly priced right now. What about small and mid caps? I know you've already mentioned liquidity as a risk, but are there any other risks if one wants to play in that space?
I think those are the 2 essential things, at least concerning this market, that you have to be aware of if you're investing. One, these mid-cap stocks, how have they performed over the time? Fundamentally, if you're sound, you are sound. There's no other way to it. So either fundamentally you're sound, technically you're sound. What could be driving the technicals? That would be the liquidity. Probably you don't have enough shares, and that's really pushing it. Any small interest. And if you're sound fundamentally, corporate actions is another thing that drives equity pricing in this market. If you have a good corporate action, we saw that come out in Como at some point. corporate action, everybody was interested, but there was no liquidity. Price shot up to an all-time high, and it just became a darling stock, at least for a while, till people really realized they couldn't even get into it. So it's for the people who have held it. And it's about paying off, because you can't just have an idea as a fund manager of a fundamentally sound stock, and somebody, a speculative investor, just thinks he will just reap all the gains along with you that you've been holding the stock, with seeing value when every other person didn't see value. It doesn't
do you see any risks for this market? We're in a great place right now for the economy. The Naira is stronger. I think it's gained about 3% this year. Oil prices are good, well over $110 per barrel. We just had the budget announced. So we're seeing, at least on the fiscal side, spending hopefully should happen early going into next year. But are there any risk in the context of this economy today that you think investors should pay attention to that could flip things a little bit?
It's a lot of economics does come into play. There are a lot of things that has to do around inflation as well. Recently about the floods, that is definitely good, and we all know that food pricing has a lot to do in the inflation index in Nigeria. Now, if that is going to take another lag effect of another 3 months, we should be expecting inflation to hit hard at that point. If inflation is going to hit hard, consumer spending is going to be reduced because it's a function of disposable income. Now, moving forward to that point, now you might now want to start projecting that maybe instant processed foods, like the noodles and all the rest, will be what will really gain. But definitely there's another point, distribution. We have security challenges as well. So it's not as much as just looking at the things within the basket. You must really look outside the box and the basket as well to know definitely the sort of risks that are so much playing. The security risk and the liquidity for the ones that are listed. And then the natural disasters, just as the one that is happening as well. Then the what is happening internationally, the flow of capital into the economy, is it going to continue? Is this what we are seeing? We've been seeing 80-20 in terms of equity indexes. Now
foreigners are dominating the market, clearly.
So the stream of inflow, is it going to keep continuing? What challenges are they facing? I mean, the debt crisis they have there, is it fully leveled out, and is it going to continue? What is the disposition of the international fund managers towards our security risk and the challenges we have in the economy at the moment? So it's a whole myriad of issues, which I think
the markets are a risky place. It's difficult to call them